Our next speaker is overseeing some frontier technical experiments, or has just overseen some frontier technical experiments. Brad Jones is the Assistant Governor, Financial Systems of the Reserve Bank of Australia, and he will speak before being interviewed by James Ayres on our stage. Please welcome Mr. Jones. Thanks very much.
Good morning. Thank you to the AFR for the opportunity to share some thoughts on the role that tokenised assets and money might have in shaping the future of Australia's financial system. My remarks today will centre on three themes. I'll begin by drawing out some lessons from history as they relate to the evolution of our commercial and monetary arrangements. I'll then outline the opportunities and challenges arising from the tokenisation of assets and money in the digital age. The punchline here is that tokenisation offers some intriguing possibilities, but it's not without its challenges, and more work is needed to understand how we can yield the benefits while managing the risks. And finally, I'll discuss how these issues connect to the next phase of the Reserve Bank's work program on the future of money. Let me begin with some history. One lesson relevant to our own times relates to the codependence of our commercial and monetary arrangements. We've seen this when commercial activity has chafed against the constraints of the existing monetary system before new technologies enabled the monetary system to adapt to new forms of exchange. Take here the introduction of paper money. The issues facing merchants trading across the expanses of the Middle Kingdom in China 1,000 years ago were similar to those plaguing the merchants of Renaissance Europe 500 years later. In both cases, a chronic shortage of high-value coinage was a severe constraint on commercial exchange. Lugging around piles of copper coin was hardly conducive to trade. But with the invention of paper and eventually the printing press, a revolutionary solution was born: paper money. This interdependence didn't stop there. The Industrial Revolution that fueled the expansion of global trade was preceded by all manner of financial and monetary innovations. Among them were new forms of money, like bills of exchange, alongside new types of financial infrastructure and intermediaries. Think here of the paper ledgers overseen by the Medicis of Florence. Turning to the computerised age of our time, the dematerialisation of finance has seen paper-based forms of assets, money and record ledgers give way to electronic variants. This has fuelled efficiencies that must have seemed unimaginable half a century ago. A second lesson we can draw from history is that in the absence of public money evolving to support new forms of commercial activity, private money has attempted to fill the void, but with decidedly mixed success. Consider here the disastrous experiment with privately issued notes by wildcat banks during the US free banking era in the mid-19th century. This was a period where there was no national currency in circulation, and private notes traded chaotically and at large and variable discounts, highlighting that monetary instruments lacking in trust can do more damage to the economy than good. The clearest success story with private money has been the digital money issued by well-regulated banks in recent decades. In all modern economies, Australia's included, this form of money has become dominant, and there's good reason for this. The enduring challenge for private money is to closely replicate the special features of safe public money so that they can be interchanged at the same rate. This requires private money to have enough credibility so that the public is willing to exchange it at par and without question into public money or into goods and services. Private issuers have sought to bridge this trust deficit by fully collateralising the money they issue and or by subjecting themselves to regulation and supervision. In recent years, unbacked cryptocurrencies issued outside the regulatory perimeter have tried to buck this pattern, but largely without success. This brings us to a third and final lesson. The two-tier monetary system, comprising central banks and trusted private intermediaries, has served the economy well because it combines the best features of public and private money. Comparative advantage helps to explain why. A reputable central bank is uniquely placed to serve as both an anchor and an enabler in the two-tier monetary system. As an anchor, it provides a foundational level of trust. Trust in the value of public money, trust in the finality of payments by settling claims at par across the central bank balance sheet, and trust in the stability of the wider financial system. As an enabler, the central bank promotes competition by providing base infrastructure on which private entities can then innovate to meet the preferences of firms and households. So as we contemplate how monetary and financial arrangements might evolve in the years ahead, I suspect our efforts should be concentrated more on uplifting rather than replacing the two-tier system. And this is where tokenisation comes in. Let me now discuss some distinguishing features of a tokenised financial system and why they offer some interesting possibilities. The simplest way to think about the tokenised assets I'll speak about today is as digital bearer instruments that represent claims on underlying assets that exist in the real or off-chain world. But tokens confer more than just property rights. They contain rich information that can be updated instantaneously and can be programmed via smart contracts to perform functions that are not seen in traditional finance. It can be exchanged bilaterally 24/7 on public or private decentralised ledgers. There will be a role for intermediaries here, but the role's likely to change, reflecting a reduced need for market making and hopefully less manual reconciliation of records, which can be costly and prone to error. While the full potential of tokenisation requires assets and money to exist on the same ledger, as this would allow for atomic settlement and the real-time updating of ownership records, separate but synchronised platforms could achieve a broadly similar end. So much for the technology. The threshold policy question is what potential benefits could tokenisation crystallise, and are the downsides manageable? These issues need to be understood in the context of the frictions and risk that exist in our current system. Let's start with some potential benefits. The first set of benefits relate to increased liquidity, informational transparency, and auditability. More timely and complete information available in tokenised settings could help to complete markets and boost economic efficiency. For instance, consider that pricing in the $750 billion market for bank term deposits, comprising around 15% of bank funding in the country, is still largely conducted over the phone, in branches, by email, and on spreadsheets, much like 25 years ago. Is this the best we can do? Separately, enhanced auditability is one channel by which informational transparency could spur activity in developing new asset markets. This is particularly relevant for nature-based asset markets like biodiversity or carbon credits, where data needs to be verifiable in a timely way to build trust. Tokenised markets for green bonds, where coupons are linked to real-time measures of clean energy generation, are just the tip of the iceberg here. More generally, the combination of better information, lower barriers to entry from direct access to markets, fractional ownership, and the ability to transact and settle 24/7 could increase the scope for mutually beneficial trade. This includes by lowering the cost of capital for existing borrowers, opening up access to capital for new borrowers, and widening the investable universe. A second set of benefits relates to reduced risks, costs, and improved capital efficiency from shorter settlement cycles. Eliminating delays between trade execution and settlement in tokenised markets could free up collateral and reduce counterparty, operational and market risks. A third benefit relates to reduced intermediary and compliance costs. Token programmability has the potential to cut through layers of manual processes currently embedded in the trade life cycle. Given that transactions in the securitisation market can often involve up to 12 intermediaries, it's little wonder that fixed income markets are viewed by some as ripe for disruption. A similar point could be made for cross-border payments, where costs and settlement delays are still far too high. The programmability of asset tokens could also help to take out costs and frictions in compliance checks and in asset servicing, including the payment of interest and the conditional rebalancing of asset portfolios. One way to view the growing interest in tokenisation can be seen in the issuance of $4 billion US dollars in tokenised bonds in recent years, spanning the official sector, banks and corporates. However, none of this is to suggest that a transition to tokenised finance will be without its challenges, and a few stand out here. First is regulatory uncertainty and compliance obligations. It's a perennial regulatory challenge to ensure innovation can flourish in a way that's consistent with financial stability and consumer protection. And we heard a bit about that this morning from the Minister. Some innovations in tokenised finance have occurred in a grey zone, right on the edge of the regulatory perimeter. The common theme globally is uncertainty around governance and risk management responsibilities. If a smart contract on a decentralised ledger goes awry, cross-border and AML responsibilities do not disappear, but who is accountable? Only a small number of jurisdictions have established completely new regulatory frameworks supporting tokenised asset markets, while others have observed that innovations in tokenised finance should operate within existing regulatory frameworks. In Australia, work on a regulatory framework for tokenised assets is being led by Treasury with support from the CFR agencies. A second issue is interoperability. As investment in new technologies can be costly and take time for participants to implement, tokenised asset markets will need to be interoperable with traditional infrastructure for the foreseeable future. Communication between on and off-chain technologies will be especially critical to limiting fragmentation between assets that are traded across different venues. This could otherwise result in different prices and ownership information existing in relation to the same underlying asset. And investors may seek the assurance that if the on-chain network malfunctions, they still have recourse to the underlying asset recorded and held off-chain in the so-called real world. Third, there's the impact on transactional liquidity from pre-funding and fragmentation. In a world of atomic settlement, trades would need to be pre-funded. This will increase liquidity requirements for market participants. If intermediaries contribute significantly to traded volumes, this could lead to pre-funding costs being passed on. Liquidity conditions could also be made worse by the fragmentation of trading volumes between decentralised platforms and traditional market infrastructure. To sum up, we should be wide-eyed to these challenges. It's very possible they can be overcome, but more work here is needed. Let me now turn to the four main forms of tokenised money that could have a role in tokenised asset markets: unbacked cryptocurrencies, asset-backed stablecoins, tokenised bank deposits, and a wholesale CBDC. By process of elimination, I'll begin with unbacked cryptocurrencies like Bitcoin that natively use blockchain technology. The fundamental issue here is one of trust, or a lack of it. With no reference to backing assets and operating outside of regulatory oversight, the wild price volatility in cryptocurrencies has made them more amenable to speculative asset investment than serving as a safe settlement instrument. A lack of fungibility, scale issues, and high fees have also rendered them, so far at least, ill-suited as a medium of exchange. Now, it's possible that unbacked cryptocurrencies remain a hotbed of speculative investment interest, but I struggle to envisage them acting as money in an expansive way in the financial system of the future. It's certainly plausible that stablecoins issued by well-regulated institutions that are backed by high-quality assets could settle tokenised transactions. But it's more contestable whether this would be the case for stablecoins issued by institutions that currently sit outside the prudential regulatory perimeter, including non-bank financial institutions and big tech. Of the various issues here, the most fundamental is the risk that a stablecoin issued by a non-bank would be more likely to trade below par compared to those issued by banks, reflecting differences in perceived credit risk. History tells us that much will depend on the effectiveness of the regulatory regime governing stablecoin issuance. Some of the features of tokenised bank deposits may make them even more suited to settling tokenised transactions than stablecoins. Consider that when payments are made today using bank deposits, their interchangeability at par with central bank money is underpinned by prudential supervision and the central bank facilitating settlement of obligations between banks. That system would not change in a world where interbank payments were made in tokenised bank deposits. The risk of fragmentation might also be higher for stablecoins than tokenised bank deposits. Interoperability problems could emerge if, as seems plausible, competing stablecoin issuers felt they had no incentive to support trade in rival stablecoins. But given deposits issued by a range of banks are already widely exchanged and settled across the central bank balance sheet, the introduction of tokenised bank deposits would represent a fairly minor change to current practice. Another issue more relevant to stablecoins than tokenised bank deposits relates to their potential impact on markets for high-quality liquid assets. In some countries like Australia, the government securities market is not particularly large, and a material share of outstanding issuance is already encumbered in liquid asset requirements for banks, in repo transactions, and in central bank holdings. In the absence of a CBDC serving as a backing asset, there's a question whether there would be sufficient high-quality collateral in Australia to support stablecoin issuance at scale. I've said little yet about where a wholesale CBDC could fit into this tokenised system. One possibility is that a CBDC might not actually be necessary at all if, for instance, our financial infrastructure can be modernised in certain ways. An example here is the so-called trigger model, where settlement is triggered via an interface between the existing real-time gross settlement system and the platform where digital assets trade. Some countries are looking very closely at this now. But at the same time, of the various forms of tokenised money, only a wholesale CBDC would be completely free of credit and liquidity risk. In representing the ultimate form of safe money, it could help to both anchor and spur innovation in the financial system, including realising the full benefits of atomic settlement and programmability. as a wholesale CBDC would simply represent an advanced form of central bank money that has underpinned the Australian financial system for decades. This would represent an evolution rather than a revolution in the two-tier monetary system. These are some of the reasons why the bank and some of our peers internationally are actively examining the case for a wholesale CBDC. Quantifying the potential benefits of tokenised exchange is a challenging exercise, not least because it's a greenfield area and tokenisation could support the growth of markets that don't currently exist on any scale. At the same time, it's possible to sketch out some hypothetical scenarios for reduced transaction costs and the cost of capital that reflect just a small fraction of the benefits that emerged in the electronic trading era. When we run such an exercise, we find hypothetical transaction cost savings in Australian financial markets could land in the range of $1 to $4 billion per year. And this reflects two drivers. Tighter bid-ask spreads reflecting increased trading volumes, and gains from atomic settlement driving down other fees, including those currently paid to correspondent banks, savings from reduced collateral requirements, and reduced fees from a lower incidence of settlement fails. A second set of hypothetical estimates suggests that savings of up to $13 billion per year could be available to issuers in the Australian capital markets. The ranges here reflect a range of assumptions for the decline in the cost of capital from lower liquidity risk premium, and different assumptions for the share of outstanding issuance that is refinanced at the lower cost of new issuance. But ultimately, it won't be possible to make concrete statements about the effects of asset tokenisation until the ecosystem is better developed. It does, however, seem reasonable to surmise that two types of markets stand to benefit most from tokenisation. Greenfield markets that could develop rapidly by leveraging programmability and better informational transparency, and established markets that are characterised by manual processes and that don't already benefit from efficiencies resulting from active trading and derivatives. In an effort to better unpack these issues, this is emerging as an active area of research at the bank and with some of our research partners. Let me conclude with some takeaways from our recent CBDC pilot project and how these connect to the bank's Future of Money program. First, the project highlighted a range of areas where a CBDC could add value in wholesale payments. In particular, around 1/3 of the piloted use cases assessed opportunities for CBDC-enabled atomic settlement to enhance the operation of new or established financial markets. We've taken a signal from this industry interest. Second, the project highlighted opportunities for a wholesale CBDC to act as a complement to, rather than substitute for, private digital money, that is, tokenised bank deposits and asset-backed stablecoins. Third, further applied research is needed to better understand operational design issues for new forms of ledgers, including interoperability between on and off-chain ledgers. Fourth, and more generally, the project highlighted the importance of a modern regulatory framework that supports innovation in digital financial services while safeguarding financial stability. We heard this morning from Minister Jones on some of the new initiatives to that effect. I think, enhancements to the regulatory sandbox arrangements in Australia, possibly informed by the UK's recent experience also seems worthy of further consideration. So where is the bank on its future of money journey? Our overarching position is that we remain open-minded as to the precise functional forms of digital money and supporting infrastructure that could best support the Australian economy in the future. We have an active research program underway and we're letting the evidence guide us. Some focal points for this work program over the next year are as follows. First, we're in the early stages of planning for a new project, assessing how different forms of digital money, tokenised money, and infrastructure could support the development of tokenised asset markets in Australia. Second, the Bank and Treasury will publish a joint report around the middle of 2024 that will provide a stocktake on CBDC research in Australia and set out a roadmap for future milestones. Third, the bank will continue to actively contribute to international work streams, including those aimed at reducing the frictions in cross-border payments. And fourth, the bank will step up its engagement with a range of external stakeholders on the future of money. This will take a variety of forms and include industry, academia, government agencies, other central banks, and the wider Australian public. In closing, the question of how we might arrange our monetary system to better support the Australian economy in the digital age is now a key priority for the bank. We are on a journey here and look forward to engaging with you and your ideas on how this might best be achieved. Thank you.
Brad has just agreed, ladies and gentlemen, to answer a couple of questions. If anyone in the audience wants to ask one, please raise your hand. We'll come to you. There's just time for one or two. There's one there, so we'll come to you, sir. Let me just get started. Thanks very much for taking some questions, Brad. So those cost savings that you've disclosed, I think for the first time today, 13 billion potential cost savings for deploying tokenised assets into the financial markets, and there was another slide there where you were showing a $1 to $4 billion a year potential cost saving as it relates to reducing bid-ask spreads. Now, you made it very clear this is very early days. We need to do a lot more work to realise, whether or not those cost savings are going to be accurate. But it's quite a large number, and you've also talked about quite a few risks that need to be counterbalanced against those, such as pulling apart the pools of liquidity and interoperability of systems and a range of stuff that you're working through. But when you see potential cost savings of $13 billion a year to the financial sector, does that sort of strike you as a number worth going for? Do you sort of feel at this stage that those savings are of such a quantity that the work that still needs to be done to get there is worth pursuing in quite a determined fashion?
The threshold policy question that we need to answer as a country is, are the benefits of what we're talking about here going to be significant enough, potentially significant enough, to warrant all the disruption that it would entail? I wouldn't get too hung up on the precise numbers mentioned today. They were really just the results of a hypothetical exercise where we went back and had a look at what the transition to electronic trading did for markets in terms of traded volumes, bid-ask spreads, lowering the cost of capital, and we said, right, just as a hypothetical scenario, let's assume just a small fraction of the benefits that we observe with the transition to electronic trading were to flow from the move to tokenised asset markets. So if we take those ranges and apply them to the data we have today on outstanding issuance in Australia and traded volumes, let's just combine those two bits of data together to give us a sense of what we could be talking about. The numbers seem sufficiently large to us that at a minimum, it's worthy of further investigation, and that's why, as I said, the bank and a number of our research partners are actively looking at this space and doing a lot of related work.
Okay. Another part of your speech that just jumped out at me as I was listening to it was the history of private money that obviously has had its issues. You mentioned the wildcats in the US in the 19th century. You spoke about the two-tiered monetary system developing sort of on the back of that, where the RBA acts as an anchor and a trust and also as an enabler. And then you said it would probably be, the benefit of the system as we think about stable coins for them to be issued by regulated banks rather than non-banks and rather than big technology companies. So we right in thinking about that the Reserve Bank and more broadly Australia is probably quite wary of big tech coming in with equivalents to, say, the USDC that is issued by Circle in the United States, or even Facebook had a go at this kind of thing with Libra a few years earlier. That's not the way we should go here. It feels like stable coins issued by the large four banks, which can be regulated like bank deposits, is the way that you see the market developing, and then tokenised bank deposits coming in as an addendum or in parallel, or it's quite sort of similar structure to that. You prefer to see stable coins issued by the major banks and not non-banks and not technology companies?
The most important thing with stablecoin issuance is that that issuance takes place sort of within the regulatory perimeter. Now, how that perimeter is redesigned for stablecoin issuance and other forms of tokenised money is a very active issue. Treasury has a licensing paper out issued in June, which spoke about how stablecoins, about the case for stablecoins being issued basically as a stored value facility, and we're very much supportive of that. I don't want to give the sense that only the big four banks can operate in that space. I think it's more important that the regulatory regime's in place so that people's money is safe, the payment instrument is safe, it's credible, it's backed by real assets, or at least it's governed by a prudential regulatory framework. Because we know from history that unbacked private money that's not backed, not appropriately backed, or where issuance is taking place outside the regulatory perimeter has really struggled to build the trust that's needed to ensure that it trades at par with central bank money and won't be discounted when it's used to trade in for goods and services. That's really the key point. So I wouldn't get so hung up on the big four piece. It's more the overarching, there needs to be an overarching framework though.
Okay, thanks for that clarification. There was a question in the middle of the room here. If we could just get the microphone over to you, sir. It's just on its way, just so we can hear it on the webcast.
Drew Bradford, in your work that you've done, did you look at a CBDC potentially crowding out private money? Did you see any danger of ability to deposits that are currently, that banks in general use to create private money? People currently don't have access to leave their money with the Reserve Bank, but a CBDC would potentially allow that. Did you see in your work?
Yeah, thanks for the question, Drew. That is a material issue that we are very cognizant of if the bank were ever to issue a retail CBDC. I gave a speech about a year ago which actually set out some of the thinking around those issues, and they are material. They are one of the factors that would have to be very carefully weighed if the bank were ever to go down the road of issuing a CBDC, and you see central banks that seem quite likely to go down the road of issuing a retail CBDC, putting in place safeguards, principally in the form of caps, around how much CBDC could be held by individuals. Now, the bank is not of a mind where retail CBDC is high on our agenda. We've had a look at it. We're keeping an open mind, but at the moment, our overarching framework is we see more potential benefits on the wholesale CBDC side and less risk of some of the negative externalities, if you like, such as those you just spoke to, compared to a retail CBDC. So the cost-benefit analysis at the moment has us focusing more of our efforts on the wholesale CBDC side than on the retail. We're keeping an open mind, but at the moment, the wholesale CBDC side is really where we're focusing our resources.
Okay, well, ladies and gentlemen, please join me in thanking Brad Jones for his speech and the questions.
Thank you.